Well, hello everybody, and welcome to another episode of the Places We'll Go show with your hosts, Mark and myself, Richie. Now, this week, you're in for a real treat and a bit of a twist, as we have Tom Lewis, who is the Group Finance Director at the Zenodin Group. Welcome, Tom.
Morning, thank you.
Now, look, guys, Tom really is a finance powerhouse with experience of private equity, M&A, finance management, cost reduction, as well as different business models from things like B2B marketing right through to SaaS. Now, let me give you a little bit of Tom's career history. He has worked for some of the most well known PE firms in the land, such as Inflection and Exponent, as well as held the CFO role at the likes of Ogilvy. He has also been the COO at the Institute of Practitioners in Advertising. Now, today, I'm sure he's going to give us a critical and honest view of his assessment of the advertising industry, as well as the pros and cons of forging a career in this space. I just want to say that Tom recently wrote an article that really caught my eye, and that was titled How to Leave Adland. So I think it gives you a real sense of his perspective that he may bring to this conversation. So without further ado, welcome, Tom. It's an absolute pleasure to have you on the show.
Thanks, Richie. Thanks for having me.
Yeah, likewise for me, Tom. Great to have you on. And we're going to jump into that article pretty soon. But before we do, let's just get started. Like, how's 2024 shaping up? We're done with January and Feb, which is always a good
Yeah.
milestone. How's it all shaping up?
Busy at the moment. Lots going on. Zenodin, our financial year end is May, so we have audit and year end coming up. Lots of projects going on, and I guess it's in the nature of private equity that it does a lot of things at the same time, a lot of things very quickly, which keeps us all busy, which is what I like.
Fantastic, Tom. So tell us a little bit about the world of private equity, because it seems like quite a departure from the world that you were in Adland.
It is and it isn't. I mean, private equity is an ownership model more than a sector. So private equity sits across different sectors. The place that I'm working at now is private equity owned. It's a buy and build of small accountancy practices. So it speaks to my background in B2B professional services. It speaks to my background of buy and build. So a lot of the landscape within the company looks very similar. But private equity has a certain way of doing things, and that's where sort of a lot of the challenges are of helping the business navigate an accelerated growth journey.
So that's great. And it's somewhat incongruous, therefore, maybe that you would have written this article that we talked about, How to Leave Adland. So, let's jump into that.
Yeah.
We'll maybe come back to sort of how you got to this point. But it's a good tipping in point to say, tell everyone about the article, why you wrote the article, and yeah, I'll leave it there.
Yeah. Why? So I left Adland probably 5 to 10 years ago, and I'd been in for almost 20 years, and the final role, as you say, was at the IPA, and at the IPA, I'd had visibility into certain sector-wide issues, and one of them really was the commercial challenge. And the idea, as I saw it, our challenge was, well, how do we help our members become more commercially successful? And what data would show that our members were becoming more commercially successful? And the key measure for any professional service, knowledge capital business really is revenue per head. Your cost of delivery is your fee earners, your people who service clients or provide services to them. The price you charge on those is the revenue you charge. So revenue per head is a good measure of effectively your gross profit, how much money you're making on what you're selling. And at the IPA, what I saw was that those numbers have been in constant decline for more or less 2 decades. And what you can afford to pay your people in a sector where you're selling people's time is fundamentally tied to how much you charge for them. And so therefore, the inescapable conclusion was that marketing services has a real pricing challenge. And as a result of that, it doesn't pay as well as other sectors such as law, accountancy, management consultancy. And we see that in our own business. We're seeing, we see it the other way, that if there's salary inflation in the market, we need to reflect that in the prices we charge to our clients. So to me, there's a very clear link between what you charge to your clients, what you can pay your staff. And Adland has a real problem with its pricing, with its commerciality. It's got a real commercial challenge. And I think it's got beyond the point where it can get its way out of there. If you look at all of the activities happening within sort of the holding company area, it's everything that you do in a mature market. So it's cost cutting, it's mergers, it's slashing investment. All of these things mean that Adland, if you work for the likes of the big holding companies, it's not a nice place to be at the moment. And I guess coming back to your original question, Mark, why did I write the article? It started with a few offline conversations with people of I want to get out of the sector. What's your advice? And sort of I thought, well, what I've done here is almost written an article in sort of LinkedIn messages, and then somebody popped up and sort of asked a question, and I said, well, if I turn this into an article, would you read it? And he said, absolutely. So went back to those emails that I'd sort of exchanged with people, topped it and tailed it, and there's your article.
There you go, and a really insightful one at that. So many questions spar from what you've just said there, and the revenue per head metric is certainly an interesting and one that we're very wedded to as this industry. But I imagine other industries that you've described, places like law and accountancy, do have similar metrics around revenues per head.
Yes.
And therefore just wonder why and what is different about those industry dynamics that perhaps we can learn from in Adland, or that are different, that makes all the difference here.
Yeah, definitely. I mean, either revenue per head is a key metric, and why do some sectors have a better revenue per head figure? Number of factors. I think one is if you've got letters after your name, if there are barriers to entry within the industry for practitioners, that then gives so you command a certain degree of respect. It's harder to get people to get into the industry, and therefore clients have to be prepared to pay more for the services of people with letters after their name. If you're a regulated industry, if you're dealing with law, things that change, so accountancy, tax, law, all of those things will change from time to time, and therefore law firms, etc., will have to continue training their people to make sure the knowledge remains current. There's another barrier to entry because of the cost of staying up to date. Another factor is, I think, client size. So the more dispersed your client base, the more pricing leverage you have. It becomes more acceptable to walk away from a client if the price doesn't suit your commercial aims. Ad agencies, PR agencies, a lot of those types of businesses typically have a relatively small client base, maybe 20 or so clients. That makes your credit control easier because you've only got on your invoicing process easier, but it absolutely destroys your pricing leverage because you become so dependent on a small number of clients, and therefore those pricing conversations are a whole lot more difficult. Final point I'll look at is that you've got the rise of professional buyers. They started in 80s, 90s looking at physical widgets, pass-through costs. Once they'd done with that, they then moved on to other areas of large spend, and marketing services was the next place they came to in the early noughties. And I remember procurement being a new thing, and Adland having to say, well, how do we respond to this? And I think the reality is that professional buyers, because they had learned through dealing with manufacturers of physical goods that they were buying, were always several steps ahead of sellers of professional services. And what I've seen is that sellers have never really responded to that challenge. They started in a good place, margins were good, and so it was relatively easy to give way slightly to procurement and say, well, that the easiest thing is to agree to what's needed. But over the years and years, all of the fat has been cut away. Arguably, you're not just down to the muscle; you're down to the bare bones in some places. And so that opportunity to learn the skills of professional selling, to respond to professional buyers, I think that window has actually closed, and that's why I have such a negative view of what it's like to be in ad land.
Tom, you're taking me all the way back to my economics degree with all of this. Fascinating macro dynamics, and it chimes with a couple of things. One is that in many cases the chief procurement officer has higher status than the chief marketing officer on the client side. I'm going to jump into the parallel conversation about pitches, because obviously they're a huge squeeze on agencies, and the conversation about, well, should clients pay for pitch work or not? Because there's always a fever pitch, and I've heard CEOs say, if I lose one big client, that could cost me my job this year. So there's an intensity around all of that. What's your perspective on the pitch dynamic?
Yeah, I mean, you said, should clients pay for pitches? I don't see it as who should do what. It's who's got the power in the relationship to do what. Clients have the power to make agencies jump through loopholes and go through an extended pitching process. And if you have the power, you will use it. It's really just an indication of that lack of commercial skill and that lack of power that pitching is so prevalent. And I think no amount of hand-wringing within Adland pledge will make any difference. Pledges don't make any difference. The reality is the market likes you to be able to control your costs. If you as a buyer of services have the capability to control that cost and to drive down price, that's a market expectation. So we live in a very short-term world. If you can't grow your revenue, the next best thing you can do is manage your costs. So that's the dynamic. Why are agencies forced, or ultimately why do they accept this need for pitch? It's about differentiation. If you want to have power in the selling process, you need to be able to do something that few other people can do, and ideally no one else can do. Once you get to that level of selling something that no one else can do, you have much more power in the selling process. So undifferentiated ad agencies or marketing services businesses have to accept that because of their lack of differentiation, because of their lack of specialism, they do not have much power in the selling process. And therefore they have to accept a sale process on the terms that the buyer sets.
Tom, absolutely. I agree with that. And it's a lovely reframe into thinking about power dynamics. And of course, that happens at an organization level and of course, at a supplier level as well. I think will have a very unique and interesting point of view now, stepping away from the industry over the last 5-6 years, to talk to drawing comparison perhaps between the headroom available across other industries that you mentioned versus in Adland. And I wondered if maybe there's some comparison that you could draw here for us as to some of the differences in dynamics and perhaps career potential and growth across other sectors versus when you compare to your old world of Adland.
For sure. Well, come back to what I was saying earlier. If you look at other professional services, where there are barriers to entry, where they're regulated, and where the client base is more dispersed, those businesses, those sectors have more power in the selling process, so they're able to command a more sustainable price. Within that price, you can then also start to include the cost of training, the cost of developing your staff, all of those things. It becomes a virtuous circle, because if you charge a sustainable price, you can recruit the best talent, you can retain it through remuneration, through training, through career development, and therefore your output as a business is better, and therefore it becomes easier to charge a premium for it. So in my view, that there's really only an upward spiral and a downward spiral. The sort of the virtuous circle is, as I've described, the good people providing a high quality of service and doing something slightly different from what else is your competitors on the market, and it can be as simple as combining services in a way that no one else does. The downward spiral is that you're undifferentiated, you're losing out on pitches, the cost of pitching becomes expensive, your margins get thinner, you become desperate for revenue, you have to accept terms or have to accept prices on the buyer's terms. And your only response to that is to cut your cost base, and therefore you can't give people the pay rises. Your business isn't growing. There's no promotion opportunities. The good people will always leave first, and you're left with people who aren't quite as good as you'd like, and therefore your clients will look at you and say, well, as a service business, you're not providing the quality that I can see from others, and that just becomes a downward spiral.
Yeah, it sounds like a race to the bottom. So makes for grim reading or grim listening, but what's the answer? What's the solution? How to get back to the virtuous circle? Is there a way back?
There is a way back in theory, and I did a lot of work at that on that at the IPA. So let's talk about what it is in theory, and then think of real world challenges. You've kind of got to put the machine in reverse. So you have to start with the idea that how do I get more power in the buying conversation, or even where do I have it? So a service business is its clients and its staff, its talent. It doesn't. Everything else is infrastructure. So all you really look at is what do I have as a client base? What do I have as a talent base? And within that, you will have clients where you have more pricing leverage than others. So your large client that gives you the money to keep the lights on and make payroll every month is not your starting place. It's your small, slightly annoying client, where actually walking away from that business would be an option because you're not making much margin. In terms of the cash inflow every month, it's not particularly significant, and walking away is something that you could consider. That's where you have your most pricing leverage. And just in the same way that sort of tradesmen will price up a job, and if they don't really want the job, they'll often put a premium on it rather than decline to give you a price for it. You can do the same with those low-end clients and start to raise your prices, knowing that if that were to lead to a client departure, that would be an acceptable outcome. And within that, the advantage of that is you then start to learn those commercial skills, because all profit is a function of risk, and therefore if you're looking to make more profits, you're increasing your risk profile. So you start to do those things where it doesn't matter so much if you make mistakes. So the smaller clients that you could walk away from, let's say you double your prices on a small client and the client accepts it. You then have more margin. You've got something you can invest back in the business. You should also take a really good look at what you've done and say, well, did I leave value on the table? Could I have tripled my prices? Or, if you raise them by 10%, could I have raised them by 15%? That learning is absolutely key. It's not just the doing, it's the reviewing, the learning, and saying what can I do better next time. And it's a long slog out of low margin business, but it starts by improving the quality of your client base, and then taking that additional profit and then reinvesting it in growth. Now, simple and from there you can improve the quality of the service offering. You can, you've got more money to sort of hire in better people. All of those things, you're beginning that journey of getting onto an upwards spiral. Do I think the large holding companies are minded to do that? No, I don't. Again, we're in a mature market now for marketing services, and so you would be going against the grain of accepted wisdom if you started doing that significantly. And I don't believe that there's any chief executives of holding companies out there that are prepared to do that. So when a budget comes in that we're going to invest in growth, that's just not going to be accepted. It's about, well, how do we reduce costs? And you look at the number of agency mergers that have happened recently, continuing to happen. It's all about cost reduction. That is the model for a mature sector. So that's why I think that window of opportunity has now closed. Yes, there are small independents, there are consultants, all of those people, if you're an owner manager, you can afford to take that risk. You can, you have a vested interest in making it work. But those are businesses at the margins, either through size or through service offering. If you're offering some bleeding edge technology that does something different, again, you've got much more pricing leverage. You've got something much more interesting. But for sort of traditional marketing services in a large holding company, you're largely undifferentiated, and the time to invest in growth and training and all of those things, in my view, is gone.
Tom, it's really interesting, and we see this you could see this a number of ways, and I think you answered my next question, where it was there will be some people listening in who would be looking at their P&L right now in Adland and saying, hey, we're doing rather well, and it's potentially across, as you said, those more independent type agencies. And I loved your notion when you said that to have growth takes risk, in effect. So you're trading off a bit more risk in order to to achieve that growth, and the independents sort of benefit from that more because the owner manager is able to take that that action more actively than the holding cos. But I also wonder if this comes down to a little bit around business model, because there has been a whole plethora of different business models that have come into Adland. One being performance based, shall we say, or more partnership approaches where you win the spoils together sort of thing. And I wonder if that's an alternative way and means of getting away from increasing revenue per head, but getting away from that sort of pricing per bod.
Yeah, I mean, I started looking at the idea of value pricing versus cost plus, and I think that and saying value pricing is the way forwards. And I've actually come 180 degrees on that. I think there are different pricing approaches, and if you want to get good at being commercial, you need to know what they are and how they work. But I think cost plus done properly works well. So I don't think actually the model that and value pricing done badly is a disaster. So I don't think it's as simple as switching from one model to another. And by the way, it's not simple, but I don't think the model, it's execution. As I say, you can do one model well, one model badly. It's knowing what value pricing allows you to do is sort of almost have a higher ceiling on your remuneration. If you do something that no one else does, and someone is desperately in need of your services, you have so much pricing leverage. You can say, well, the price for it is X, and you can almost name your own price. So therefore, you can set a very high ceiling. It may not be a multiple of your cost to deliver. It may be many times that. So value pricing allows you to sort of raise the ceiling on your prices. But at the same time, if you're doing, and I worked at an agency where we did this and we fell foul of it. We did fixed fee work and we lost and fixed fee is value pricing because it doesn't take the time and cost to deliver as its basis. And we had fixed fee work and we could not make it profitable. We were losing a lot of money on our fixed fees. So value pricing can fail as much as it wins.
Yeah. So in its worst case, this is pretty horrible. I've noticed over the last few years that more agencies have tried to diversify a bit, be a bit more useful across more of the value chain. Branch out into data and CRM and so on and so forth. Effective or ineffective from your macro point of view?
In terms of is diversifying a good strategy? Again, I think what's important is what's your pricing leverage. So are you offering a service where you can charge a premium, and therefore what's your client base look like? If you've got a diversified client base, then you've got more leverage in the selling process. The other bit, of course, is what's the size of the buyer relative to the size of the seller. So in a simple example, if I'm selling to a global multinational with a professional buying department, and I'm a small owner managed business and I'm undifferentiated, I'm sort of on the very much the weaker party. If I'm a large professional business and I'm selling to SMEs or to private individuals, example of that being legal services, then I've got a much stronger pricing leverage. Now, there are regulations around what you charge and how you charge, but it allows you to command much more sustainable prices, because as a larger business, you've got information about what it's likely to cost you to do a piece of work. So if you agree a fixed fee, you'll know typically how long it takes, and therefore what it costs and what level of seniority you need to put behind it. So I think it's all about that power dynamic in the selling process, and also having access to information about what the outcome is likely to be, what it's going to cost you to get there, and being able to hold that price.
Tom, we've spoken a lot about the macro and some really, really golden nuggets there in and around how to think about your power dynamics and dynamics across the industry and who has leverage on what. I want to talk a little bit more about the micro,
Sure.
which is the individual. The individual coming into the industry. It's a pretty hard industry to get in. There's a lot of demand for top talent here. What advice would you have for people who are currently in the industry about how to leverage what they've currently got?
I think that's a really tricky one. I mean, my advice to anyone in Adland is get out, and if you can't get out now, make an exit plan. One of the comments I had on that piece was from someone who has moved out of the industry, and his observation was he found that remuneration was relatively undifferentiated. So you could point, and you can point to your successes, and yet not be rewarded for them. And I think that's a function of being in a commercially challenged sector. A lot of the business model of Adland and marketing services is making profits based on unpaid overtime. So a lot of the profit an agency makes comes from you people work from 9 to 5, and that covers your base cost. To the extent you've got margin, it's the work they do from 5 in the evening to 7:30 in the evening. So I think when you're in a sector that's financially constrained, it becomes very difficult to for even a well-intentioned business to pay its talent, to reward success, and that's why it's such a difficult place to be.
May I just jump in for 1 second, Tom? Just because we talk a lot about the terminology around Adlan, and of course, we're almost kind of created as a homogenous whole, and of course, it's highly segmented and fragmented. But to what extent do you believe these things to be true of the marketing client side aspect of things as well? Or is it very specific to an Adlan role?
Yeah, I mean, my career has been in marketing services agencies. So
Yep.
client side, I have almost nothing to say about. Never worked sort of within a client marketing team. So yeah, that's something that's fundamentally different. What I'm talking about here is businesses that are where the model is fundamentally selling the time of people to clients to come up with marketing service solutions.
Oh, very good, very clear. So that's quite a haunting thing, that profit comes from unpaid overtime. So I'm going to do a bit of a detour now, which is, you know your craft, you've pivoted a few times in your career. I'd be interested to know about what do you think where does your thinking come from? What is it that has led you to this point to have the knowledge and authority you have?
Well, I spent about 20 years in marketing services businesses, and I started off as a regional CFO for a division within a holding company's owned agency. And so I had 10 markets reporting into me, and some did well and some did less well. And so there was always an interest in, well, why is that country doing well and why is that country doing less well? And you could point to certain things, but never really found out what was the secret sauce, and then went on to do various other roles. So went to a buy and build. Again, same sorts of things happened, that some companies performed and some didn't. So my first 10 years were corporate roles, and then my next sort of 10 or so years were a combination of working with owner-managed businesses that were gearing themselves up for sale, and then some time at the trade body. So, at each business I went to, sort of the owner-managed business, they never made as much profit as I knew they were capable of, and sort of by the time the numbers get to the finance department and you're reporting them, the finance department is inherently reporting on the past. It's too late to change anything. And I thought at the time it was sort of my lack of ability as a commercial CFO to make these agencies more profitable. And when I went to the trade body and I met with, we ran various groups and committees, and I met with other CFOs, and we all had the same challenges. And I started to realize, okay, it's not me, it's not my own lack of commercial capability. There's something inherent, something structural about how marketing services works, that we're all facing the same challenges and we're all finding these things difficult. And that sent me off on a route to look at, well, what is causing it? What is the problem that we're all facing? And we'd often have these meetings in my early years, and we'd talk about the same things, and we'd sort of have a bit of a grumble, and then go back to or the other guys would go back to their agencies, sort of feeling a little bit better and having got it off their chests. And I thought, well, yeah, but that we haven't really changed anything. We've just had a coffee morning and done a bit of hand wringing. And so I say that sent me off on a sort of, let's go find what this problem is structurally for the sector. And really that's what brought me to pricing. It's three things. It's pricing, selling, and negotiation. And that's sort of the holy trinity of commercial success. So spoke to some, if not the best speakers, thinkers, authorities on pricing, selling, and negotiation, and started to build conferences around the work that they'd done. And the more that I looked at it, the more it became clear that that's where the challenge is. And in order to change that, and as we were saying earlier, in order to put the machine into reverse, you have to do some investment in training and commercial upskilling. And really, if you don't have the buy-in from the very top leadership, what you do at the lower end is irrelevant. You've got to have complete buy-in from the most senior person in that business in order for that to make that change within the model. And I think that's why it's more feasible at small independents, because you've got an owner manager who can make that decision. Whereas, in the larger holding companies, people may have the title CEO of a region or even of an entire agency. The reality is they're middle managers, and there's only one CEO, and that's the person who's sitting at the holdco at the quoted company level.
It's fascinating, Tom. It really is. And you speak to the inner workings at such an intricate way of this industry, and I love that holy trinity of pricing, selling, and negotiation. I think that's a really fundamental model for all of us to think about. One of the things that is close to our hearts is the world of DE&I, so diversity and
Yeah.
inclusion. And if you read the sort of latest results from the Advertising Association, they do a lot of work in understanding the dynamics of the industry. Clearly, we have a challenge when it comes to DE&I and even things like equal pay, promotion opportunities, career enhancement, etc. I just wanted to get your take on where you see that conversation, a part of the conversation, and does that form part of the solution?
I think it's a manifestation of the underlying problem rather than part of the solution. All of the problems that marketing services businesses face are as a result of poor commerciality. So if we take diversity as an example, what would you have to do to get more diverse talent in? You need to have to make it an attractive place for people to go. You need to have career progression, training, the idea that you would have a career there beyond your 30s. All of those things will make your sector attractive to the best talent, regardless of where they come from. So, and all of that it comes from having a good commercial offering. So to me, it's just a manifestation of the problem. And again, this is what I picked up at the trade body, you look at everything. You say, well, we're not digital enough, we're not agile enough, all of those things. We're not diverse enough, we're not creative enough. Whatever challenge you face as a business in marketing services, all of that needs to be invested in one way and another, and that investment has to come from sustainable pricing. So if your pricing isn't sustainable, you start off, as I said, 20 years ago, you cut some of the excesses, and Adland was probably quite famous for its excesses. The summer parties, the free breakfast, all of that stuff. I loved that when I joined the industry, and one by one, economic crises happened. Some of those things disappeared, and you said, "Well, I didn't mind that. Didn't really need a free breakfast. I can eat something at home." But that just became a slippery slope, and all of those things disappeared to the point where there is no career for people in their 50s because we're too expensive. We have to go and find something somewhere else. And since I left, that age barrier and the point at which people tend to leave the industry has just got younger.
And yet this sort of crazy cocktail of indulgence and jollies. I mean, there's obviously more to it than that. But
important strategic conversations and future horizon scanning and
so how does
leadership?
How does Can continue? Oh, no, obviously it's interesting. I mean, part of the answer is there's been a swing perhaps towards the big tech presence. Yeah. But what is your take on Can?
Never been. Not a particularly strong opinion on it, other than there will always be money at head office for something, won't there? I mean, head office is I say that as someone who's worked at head office and someone who's worked in the operating company. So money can be found for things. And if it's a head office, there are different budgets.
Yeah.
And so there may be a budget for that sort of thing in one place. And I get that's part of I suppose what you need to think of if you're the makers of Can, if we can call them that, are looking at which budgets they're tapping into to command premium prices. And so if you're running a business, you need to look at how does your client or your client base view you? Do they view you as a cost or an investment? Because the way you manage costs is you benchmark them against other similar suppliers, and you pick the cheapest, acceptable quality. If you see it as an investment, the more you spend, the more return you get. So, part of being commercial is pitching yourself as, this is an investment in your business. It's not a running cost. The really good trick is to turn something into a running cost whilst telling people it's an investment. But again, the fact that it's top of mind, it's got that sort of, what else is there as a competitor to Can? That it has a uniqueness about it that allows it to command a premium price.
Fascinating, and we're clearly coming up to Can season over the next few months. So it's going to be interesting what that has on that front. Tom, we're coming to the end of the segment, so I'm just going to pitch up the last question here, and it's been a truly fascinating conversation. What advice would you have for people who perhaps are in sort of the mid to senior levels about making a career change? As you say, to the crux of your article, what would be the best sort of ways in which to make a pivot?
I think if you're going to pivot, you need to have an eye on the future. Often we start our careers and we fall into a sector and we like it and it sort of carries us along. And the early the first sort of, I don't know, certainly in accountancy, which is what I do, the first sort of 5 years you rise quite rapidly, and then it gets harder because there are fewer jobs, the jumps are bigger, and it becomes more difficult. So you can sort of ride, go along for the ride in the early years, and thereafter it does get more difficult. So that forces you to be a little bit more strategic, a little bit more circumspect, a little bit more goal orientated about your career, because that rising tide that lifts us in our sort of 20s and early 30s, say, isn't there anymore, and it as I say, the landscape becomes more competitive. So in terms of advice for navigating that stage of your career, if you're in a buoyant sector, that rising tide is still there. The opportunities are still there. If you're in a sector that's difficult, it becomes a lot harder, and then you have to think, well, actually, what's my lifespan in this sector, and do I need to change sectors? And to do that, as I put in the article, I think you've got a couple of things you need to think about. One is you've got to take, as I say, a longer term view and look at what is an adjacent sector that you can move into. If you think larger companies are more capable of carrying people who are still learning about the sector, so you have to look at perhaps a more junior role in a larger company, and you've kind of got to go back to school. You'll have gained some sector knowledge in the sort of 5, 10, 15 years that you've been in one sector. As you move into another, there will be specifics of that sector that you don't know. And so you may have to you'll almost certainly have to take a status drop. You'll probably have to take a salary drop whilst you find your level in that new sector. The advantages are, if you pick a good sector, you can probably rise up again fairly quickly because you'll have been used to acting at a more senior level. You'll have those senior skills. Once you've learned the nuances of your new sector, you'll also be able to bring perhaps a more sort of strategic eye to certain things because you'll have come from other sectors that do things differently. And as we used to say when we recruited people into Adland, there's a certain amount of time before you go native, before you accept all the bad practice of your own sector. So when you come in, you have the opportunity to cast a critical eye on the way certain things are done and ask those questions of, well, why do we do it this way? Why don't we try something different? This is what we did in my last sector. And so you can bring some of the best practice from where you've come from. So having come in at having taken that status drop, probably a remuneration drop, and having had to work really hard again, perhaps harder than you've ever done since very early on in your career, that can then propel you, I think, into back up to the sort of level you want to be at. And if you're in a more buoyant sector, the opportunities will be greater.
There you go. So, Tom, what can I say? Thank you this morning.
Thank you for having me.
But both for telling it like it is, but also your insights into the dynamics and the economics of the Adland sector. So I'm just going to put a bit of a bow on it for everybody, just in terms of what some of the key takeouts. But it's definitely been a little bit different as a conversation for Richie and I, where the reality check of making your way in a sector that many people revere as being full of fun and frolics, but there is, as you point out, a strong commercial challenge, a reality check, slashing as you described it, and it's about pricing leverage and the underlying dynamic of a rise of professional buyers on the client side, and the relative competence in terms of negotiating. And I like Richie, I loved your holy trinity of commercial success. It's about pricing, it's about selling, it's about negotiation. I mean, it all seems so obvious, but of course, as per a comment to your article on LinkedIn, it's a bit about the boiling frog syndrome. Who's got the power? Who's got uniqueness? How to avoid the vicious circle and get into the virtuous circle really, really hard. How do I get more power? There's no obvious solutions, and which is why we do see agency mergers and it being a very mature sector. So I think there's many sort of pearls of wisdom in what you've said. Diversification potentially to a route to power, the impact on individuals. And as I said, it was haunting to hear your hypothesis that profit is as a result of unpaid overtime and the squeeze on the individual. So coffee mornings were not the answer. That was another line I liked. Catharsis is fine up to a point. Maybe a sniff that smaller is better. DEI challenges are merely a manifestation of the underlying problem of poor commerciality. Can comes from other budgets. On balance, I'm happy with that. Richie and I be going. We may record a few shows while we're out there, might be, Richie. But I think what's really interesting at the end were a very sanguine recap of the impact on the individual and maybe some of the career bumps. And that is the thing I'm going to end on, which is, you said go back to school. We are the School of Marketing. We're here to help people along the way. And this is the point, isn't it? It is about continuous learning. It is about managing career, being proactive, owning it, continuous learning, and being on the front foot, because sector dynamics change, and you've pointed out in the mere couple of decades, the fundamental economic dynamics of the ad industry have changed perhaps beyond imagination. So everyone needs to recognise they need to keep going back to school. So thank you again, Tom, being super insightful. And I think a lot of people will take quite a lot out of this conversation. So thank you.
Thanks, Mark. Thanks, Richie.
Thank you, Tom.